Now we look at a job order cost flow. Now keep in mind each job is different. So therefore what we do is we create a job sheet. It's a record that goes along with the job as the job is being produced on the production floor. And all costs then are chargeable to that. So think of this record as sort of a subsidiary ledger to the work in process account, which is in our accounting records. How does that look? Here's the job cost sheet. So job number 45, whatever. So many desks, 10 desks, item, desk, date required, and so on. Now, anytime this sheet goes with a job. So when somebody goes and requisitions material, they record it here. And then they record their time here, direct labor. And in that way we accumulate the costs of direct material and direct labor for the job. For example, let's assume now we have raw materials. Raw materials leaves the stores and is assigned to the job when it is issued. So therefore it goes directly as direct materials, but part of these raw materials might be indirect materials, so that would go to the account called manufacturing overhead. But here we would record it. We took 200 lithium batteries. Oh my goodness, you got to be careful with those batteries. Stock number so and so, cost, and there's the total, and it's just charged to that. And it was requested by Bruce somebody and received by Herb and what have you. So we have a record of the material that went on to the job. Now so we assign it. Raw material when it was delivered was put into here. Now when it goes to the job, 30,000 comes out, 24 goes to work in process, and so much the rest, 6,000 would go to manufacturing overhead. So that's would be the journal entry. We'll talk about journal entries later. Now visually, the 24,000 that went into the work in process account, so much went to this job here, so much to this job, and so much to this job, and you can see they've been recorded at each stage. So that takes care of the material. Now we look at the labor. Now we accumulate all, and this is product cost labor. Remember that. This is the cost of the labor that works on the product. This direct labor. It includes the hourly wages. It also includes other fringe benefits. But the person who does the work keeps a work ticket. And this guy's name is John Nash. What have you. He started at 8, finished at 12, worked 4 hours on this job, $40. Well, then we charge that from factory labor. So much goes into work in process and so much into manufacturing overhead. And here we have in the general ledger the 28,000 direct labor broken out by how much was for this job, how much for this job, and how much. Each of these jobs is different, takes a different amount of material, different amount of labor, and they're all on the shop floor being worked on at different times by different people, but everybody who works on them records their time on these job sheets. Now the last thing is manufacturing overhead. Now this is assigned by the accountant. Once the accountant gets the job sheet, then the accountant has to assign the overhead. Each job must pick up its fair share of all the indirect costs. Recall that indirect costs are those costs that we cannot measure and trace direct. We can trace it to the product, but we can't measure it. So we have to accumulate it and assign it. And we talked about that in chapter 1. So what we have to come up with is what is called a predetermined overhead rate. Predetermined, estimated overhead rate. So we have to estimate the overhead for the whole year and divide it through by the production that we expect to produce for the whole year and come up with the rate per hour, or rate per labor hour, rate per machine hour, rate per material, what have you. That's the problem in cost accounting. It's predetermined overhead rate because it's an estimate. You see, the material is direct, we can measure it, it's actual. The labor is direct, we can measure it, it's actual. But all the other costs, they're actual, but we can't really measure them, so we have to predetermine them and assign them. They're estimates. We'll keep track of the actual, and we'll keep track of the estimates that we made for each job, and at the end we will adjust our records for over applying overhead or under applying overhead. Now back to the overhead rate. There are three bases, basically: machine costs, labor costs, labor hours, machine hours. These are bases. That's what we could base our overhead on, and then use that base to assign it to the products. Now the predetermined overhead rate. Keep in mind, we must estimate the annual amount of overhead and divide it through by the expected operating activity to come up with the overhead rate per activity. And we do this at the beginning of the year. Now we may use a singular company-wide predetermined overhead rate. That's another question we'll talk about later. We can use different bases, but we must come up with some rate. That is, we're going to apply it to each job based on the amount of operating activity that job has consumed. So therefore, let's see. What we're going to do is we're going to take the actual amount. So let's just assume that it's going to be, we're going to do $2 per labor hour. So that's our predetermined overhead rate, $2 for every labor hour worked. And so the actual labor hour was 4, predetermined overhead rate was 2. We're going to assign $8. And we assign that, we accumulate in the work in process, then we assign it to the jobs. For example here, Wallace uses direct labor as the activity base. Assume the company expects overhead costs to be $280 and the labor cost for the year $350. So we're going to use labor cost as the activity base. So we divide 280 by 350, we get 80%. So therefore, for every dollar spent on labor, we're going to allocate 80 cents to cover the overhead costs of that job. So therefore, when we keep track of that, this particular job took $28,000 in labor costs, so this is direct labor, and we multiplied by the overhead rate, which is 80%, and this is the manufacturing overhead that will be assigned to the product. And so therefore, this is shift here. It would be debit that, and work in process 24, credit manufacturing overhead 22,400. So when we assign it now, we accumulate the overhead in the work in process, and then we assign it to each job based on the activity. In this case, this is probably labor hours. No, we're going to do 80%. So this job took 6,000 direct labor dollars. 80% of 6,000 is going to be 4,800 manufacturing overhead. This one took 5,000, so 80%. 4,000 is going to be assigned for overhead of that, and so on. And that's how we assign the cost to the product. Manufacturing overhead then at the end of the month is compared. The balance of the work in process should equal the sum total of all the job sheets. And that's how, but keep in mind, this is actual. Direct material is actual. Direct labor, we measure and trace directly to the job. But this is assigned. We had to have a predetermined overhead rate, and we applied it based on the actual amount of direct labor dollars or direct labor hours, but we assigned a predetermined overhead rate. And that's the problem in cost accounting.